Hi, welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, we are covering the family office investing, specifically investing in large single positions.
This is the Family Office Sherpa.
So, what do I mean by this? Now, I've worked with family office investment teams and their advisors, for nearly just over 12 years, nearly 13 years. And one of the things that I find very common is the desire for some family offices to invest heavily in a single company, either via private direct investment or via public markets. And you see that time and time again. When I started Whole Road Investments nearly 6 years ago, I was mainly tasked with the operational infrastructure improvement, things like I've spoken in the past, which is mostly around the aggregate reporting of these investment positions. And often they come with some complexity, but it also showed that there was an overarching desire, either pre-liquidity, so in the embedded office, or post-liquidity single family office, to almost take that learning from the operating business, which is this big concentrated position, and parlay that into other concentrated single positions. You often saw that, which was this particular company, A, meets our criteria from an interest perspective. We can give them some assistance in terms of intellectual property or our skill set, or we just find it interesting, or we believe that this is going to be another great company and is going to be beneficial for us in the long term. There's a real bias within single family offices to recognize, especially first generation and second generation, to recognize good leadership, good opportunities and good structures of businesses and things like that, and really invest heavily within that position or within that investments. And it does look like an outlier within the portfolio, and it's not. It's intentional. So the reason for this podcast episode, and the reason why I thought it might be helpful, is because and the thing that clicked for me was there was a recent article in the Australian Financial Review here in Australia, which is on this exact thing. And it was a single family office principal that had a liquidity event, in this case sold the franchise for Western Australia's IKEA back to the Swedish parent. And instead of going out and being, including highly diversified investments and moving away from that concentration, they just heavily backed another company. In this case, it was a biotech company. So sold the operating business and then went, what am I good at, or what do I enjoy? And that is, in this case, backing other companies and other founders. So the story in the article, and I'll include the article in the show notes, but after that initial investment, he ended up becoming the major shareholder and then chairman of the board. And it's noted in the article, which is not unusual, he typically only invests in businesses that he's involved in. It's a good segue here, which is that when I worked for State Street Global Advisors, if you mentioned passive, that was shorthand for indexing or similar like beta kind of structures. When family offices talk about passive, it's the difference between passive means that they're not involved in running the business that they're investing in. And a lot of them are active investors, in this case specifically, which was he's not passive in the way he invests, he's very active and active in this particular, even though it's a listed company, he ended up owning a significant amount of it and became chairman. So it's not passive at all. So really what happens then, right? So he becomes heavily involved in the running of the business, but also what he also does is he continues to participate in subsequent raisings. So supporting the business as it continues to raise money. And this is on the private side as well as the public side. Public side is a little bit more open, and you can see to a certain, well, you can see who the percentage owners are once it gets over that certain amount. And private is a little bit more opaque, and sometimes that's preferable, that more anonymous investment. But it's still there. And for a company that's raising money, why is this good? So if you're out there raising money for your business, sometimes the family office can provide there's a halo effect of a good name. If you read the paper, if you look at stocks, if you talk to marketers and things like that, a lot of them say, well, this particular family office is an investor. And a lot of people go, well, that's a tick. That's a green flag for me, in that makes sense. That's a family office that does their due diligence. We know the investments. We know the family that runs it. There's a halo effect there, and that attracts other investors. The other thing that also happens is there's, as it mentions in the article, there's ongoing support with raisings. So as the company goes out to raise, it must be really, really helpful and handy to go, well, we know that they're going to participate. In this case, they continued to when there was more placements on the public market, they continued to maintain their percentage ownership. And also, like we've talked in the past, there's this patience here. There is not a need for a quick turnaround. Often there's not that liquidity requirement, which is that we need to sell this to pay for this. They can be really long-term, and they can be really a really good buffer for the market cycle. Now, that's all good, but what can happen? One thing that you do see, which they're probably not going to expect, is once that owner with long-term doesn't need the capital, things like that, if you're an owner that's looking to sell that business or something similar, so if you have a goal that's this, it may not match up with your new large shareholder, because they potentially got different mindsets when it comes to what this investment means. Because for the founder, they're the ones looking to get their liquidity event to a certain degree, whereas the investor or the family office that's supporting it has already had their liquidity event a lot of the time, or they don't need that liquidity event. So I think there's just something to be mindful there. So what's worked for the office here? This is what we're talking about. So for family offices that take these big concentrated positions, or these big direct positions, it's worked when they understand the risk. They understand that having these outsized positions means that the total portfolio, or the performance of that total portfolio, is going to be heavily reliant on how that performs. If it's in the direct side, that can be a little challenging in the private side, because you don't get that continuous price discovery. If you're in the public markets, that continuous price discovery is helpful, but it's also very noisy. So you've got the good and the bad there. But like I said, as long as they understand the risks associated with those big concentrated positions, and a lot of the time they do, because let's face it, a lot of the times these families or these individuals make their extreme wealth from taking these outsized bets on a single position or a single company or a single individual. So a lot of the time that's relatively well understood. The other time we've seen it worked well is when the company benefits from the transfer of skill sets from the family. A lot of the time, the family office or the individual is invested within this particular company because it matches their skill set, or they have had deep experience with managing companies and finding other investors and things like that. So there's something to be said for that. There's a transfer of skills. I've seen that work really well. And the other thing that works well for family offices is that they have this innate ability a lot of the time to like I say, to take on this volatility and uncertainty. There is some comfort there. So as long as they're comfortable with it, I've seen that work quite well. Now, flip side of that, how have I seen it gone less well? A lot of the time, there's this idea of, I think it's called sunk cost fallacy, which is, we've invested now, we've made that decision. We have to keep going. We've put all this time, this effort and money into it. We have to keep supporting it, even if it's potentially kicking the can down the road for raisings, even though we're not 100% sure about it anymore, or we haven't got that conviction anymore. We're here, we've done it, we've got to keep going. And often that doesn't work out. The other thing is some people fall in love with the stock or the company and become blind to some of the red flags that should be popping up that they would normally pick up if it was just a single stock, or it was a fund manager or a wealth manager giving them the same sort of level of concern. They would have pulled it up, or they would have asked for more explanations on certain things and things like that. But if someone becomes in love, or they like the company or the people running it so much that they almost just sort of leave it, even though they've got concerns. I mean, I started broking in 2000, so just after the tech wreck. Well, the tech wreck was sort of petering out, and people still were holding on to these big single positions, these brokers and investors. And it was just, no, it's going to turn around. We believe in the company, we believe in the stock, and they just wouldn't see a lot of the red flags until it was potentially too late. A lot of the time as well, there's no comparative benchmarking given to them, because it's a unique snowflake to a certain degree. I know we don't measure it by the same things that we measure other companies by, or other fund managers by, or whatever. And once you do that, then you're really changing the idea of investing for the long term, and for things like, why are we investing? If you're putting it in the investment policy that it's long-term returns of a CPI plus style benchmark, then you can't just go, oh, that's for everything, but this is different. So and therefore they don't have the same checks and balances in terms of how well it's doing. We used to have a sort of an adage within broking back in the day, in the 90s and things like that, which was, sometimes that short-term trade now is a long-term investment, because what clients thought, or what investors thought was going to be a really good quick win, which is, it might be a stag on IP, listing after the IPO or something similar. If that doesn't happen, now it's a long-term investment. And to a certain degree, you kind of see these positions being put in the bottom drawer and not getting sold, because, again, to that point around sort of falling in love with the stock, it just doesn't get sold, and it just sits there and continues to sort of bumble along. The other one is the conflicted revenue of marketers, or people bringing you these stock ideas or these investment ideas and telling you that, this is something, but, you have to be wary of those that market particular investments that are also on the other side of the trade. So I think from a governance point of view, just being clear, or they need to be clear around sort of where they're being remunerated, what side of the trade are they on, where are they going to see the benefit, and where do they also have skin in the game, or skin in this particular investment, especially very large positions. So there's the good and the bad, I guess. The other thing this is right within Hall Road's wheelhouse for this type of thing, but how to avoid these issues a lot of the time comes down to the investment policy statement and the governance structure you've got in place. So in the IPS, or investment policy, state the reasoning, state the criteria and characteristics of these types of investments, and make sure it's very clear to everyone the way that we're investing and why. And then there's a process for implementation as well. So yeah, that's I thought it was an interesting topic, because we are seeing it a lot, which is this idea that we can take these big outsized single positions, but I think it still need to have that normal good governance structure around it. So that's it for the episode. Hope it was of interest to everyone. If it was, make sure to click the little bell, and if you can rate it on Apple and Spotify, that's super helpful. It sort of increases the bona fides, I guess. You can find me on LinkedIn if anyone's interested. I do post a lot of things. It's Shaun, so Shaun Parkin, Parkin, at LinkedIn. Or feel free to email me if you're a family office and you're interested in what I do for families in terms of the governance and infrastructure and things like that. Then feel free to email me, Shaun, SHAUN, at allroad, so HALLROAD.com.au. And until next time, I'll leave that with you. Thanks.